If you're a sole trader or self-employed, here's how the bank figures out what income to use for your mortgage application. I've got some draft financials here. I've got the numbers written down, and this is how they're going to calculate it. So save this so you can understand a little bit more about your own business. All right, so the key thing is you actually have to have your financials done. You'll be surprised how many people don't have them up to date, which makes it very hard for us to do your mortgage application if we don't know how much money you earn. So in this example, this person earned $485,000 for their business throughout the tax year. And then you can see there's all these expenses that are in here. Then there's a net profit, and then there is a net profit or loss after tax. So you're thinking, oh my God, are we only using this number or are we using this number? And ultimately it depends. So from the top, you've got the total income, and then you've got all these expenses. Now, some of these we can actually add back on to the shareholder salary. So you see a shareholder salary here, that is $370,000. And let's assume that is one person. So 370, we know we can at least take that. And then we look at this one here, depreciation. So that one is 13,140. We add those two numbers together. The next thing we can add is home office costs. So we can add this to the income. And the last thing we can add, if it is on here, is interest expense. So that is interest for any business related debt. So those four numbers added together is the base that we can use. So you've got the shareholder's salary, depreciation, you go home office, and you've got interest. Now, this is how most banks do it. Every bank is slightly different, and some will not let you use depreciation in this. That means we can use now $391,000 for the income. But you can see there's actually profit left in this business before tax. Net profit before tax, because obviously you've made that money, you haven't spent it on running the company, so we can use that as well. So you got the 391 plus the 62,000, which means we can actually use $454,345 for this person's income instead of that number there. Now you can imagine if you have really high expenses to run a business, which a lot of people do. This is a very lean business. A lot of people have more expenses than this. Then of course the number between this one and what we can actually use is going to be huge. But in this example, it's basically $450,000. And the other thing that you need to factor in is, does this company have business debt? Because if there's an interest charge, which we saw, that would mean that there's probably some outstanding business debt, and we have to factor that in as an expense, and that bit is way more complicated, so I'm not going to do that in this video. And for some reason, people seem to think that getting a mortgage when you're self-employed is difficult. It's not. You just have to have your financials done, and they have to be decent enough for you to be able to, service a mortgage. And that's where some people fail, is they think that their gross income equals their net income that you get to keep, and that's not how it works. Oh, and before I go, a very common misconception is, I'll just get my accountant to make my income look stronger. Hopefully you can see why that is not going to work, because we've added their shareholder salary, so what you pay yourself, and the profit together. So if you keep more profit in the business and pay yourself very little, it's going to still add to the same number, as opposed to you having all of that money paid to yourself and having zero profit, because we're adding those numbers together. So it doesn't make a difference if you pay yourself very little for tax reasons and leave lots of profit in the business, or the other way around. You add those numbers together, it's going to be roughly the same.